Welcome back. Don't let the numbers fool you. The economic reports are not always what they seem. Our goal is to analyze data objectively, uncover trends, and separate fact from fiction. Oftentimes, the headlines we see are written with a bias. They're designed to support the narrative of their respective publications. We bring no bias to the table, but rather anchor our analysis on simply just the data. For example, the following chart shows us two variations of the same data. We're going to show you exactly how data can be presented in a way that can lead us to very different conclusions. We're also going to talk about a simple method to cut out the noise and see the economic data for exactly what it is. A perfect example is the PPI, Producer Price Index report, that's released earlier today. It was widely reported the core PPI, also known as wholesale prices, rose on a month over month basis by 0.6%, the biggest increase in a year. While technically this is accurate, it's also one rather narrow interpretation of the news. The core PPI, which excludes food and energy, increased this month by 0.5%, and this is a standard figure usually discussed when speaking about wholesale prices. However, for some reason this month, many publications chose instead to report on a variation of core PPI, which also excludes trade services. And this month rose by 0.6%. I don't recall prior PPI reports singling out this variation of the report. It seemed a little odd, but perhaps there's a good reason. However, let's give them the benefit of the doubt. The following chart shows the core PPI, also excluding trade services, on a month over month basis, going back about 2 years. It was widely reported that the current increase was the most in a year and took many analysts actually by surprise, both of which technically are true. But we can see the month over month reports are quite volatile, and it's not unusual to see wide variations in the data on this short term view. It is exactly for this reason we really prefer to focus on the year over year comparisons. One month can be very different from another. Hiring tends to slow down quite a bit in December and pick up considerably in January. I think it is more helpful to view the data on a year over year basis. Compare this January to the last. Now, overall, the PPI does continue to steadily trend to the downside, showing the Fed's high interest rate campaign is in fact working. And the current report does not seem to represent any change in the current trend. In fact, the current standard PPI on a year over year basis was reported at 0.9%, the same as last month's report. The core PPI has also continued to slide lower. It is true that today's report does represent a small bump back to the upside, but today's 1.9% actually matches the same figures we saw in November. In other news today, new home sales were reported. We can see 664 reported in thousands, so 664,000 appears to be the same range for the past few months. However, on a year over year basis, the chart begins to take on a different shape. In fact, under this light, the new home sales appear quite so bleak. So, which interpretation of the data is best to use? In just a moment, we're going to talk about two very simple techniques that we can employ to ensure we consider the data in the most objective manner possible. We can also consider the building permits that were reported today. By their very nature, building permits can be considered a leading indicator to the housing market. Before a home is sold, before it's put on the market, before it's even built, a building permit is issued. So the permits issued this month can be considered an indicator of a housing market yet to come. Reported in thousands, today's figures are reported at 1470, in other words, 1.47 million. The current chart more or less gives us the impression of no significant change. However, on a year over year basis, the trend is now clearly steadily rising. Comparing this January to the last, building permits are up 8.6%. This is currently very encouraging news for the future of the housing market. What is the best way to analyze the data? There are two very simple techniques that we can employ. Number one, let the market tell us about the news. Ultimately, the market's reaction is the most important part. When interpreting macroeconomic numbers, the Fed funds futures can be very useful. Also, in our regular installment of our Fed Watch, we document the major economic numbers and their impact to the Fed funds futures and the odds of an interest rate cut in the next meeting in March. We also reference the S&P 500 as this can tell us a great deal about the significance of the report. Today's PPI and housing numbers can both be considered negative, and accordingly, we painted them red on the chart. The most interesting event we saw earlier this week was a CPI report. Notice how the Fed futures dropped 17% down to 9%, eliminating the possibility of a rate cut in March. This was a result of a very hot CPI number, indicating there is still a considerable threat of sticky inflation. Also, notice how the S&P 500 dropped to 49.19 that day. Certainly, stocks don't like prospects of higher rates for a longer period of time. Interesting, despite a hot PPI report, as they'd like us to believe, the Fed funds futures did not even blink today. Perhaps our analysis is in fact correct. So, what else can we do to get an accurate view of the data? We should take a holistic view of the economy. So, for example, let's talk about the lock-in effect. Homeowners choose not to sell due to high interest rates. You see, we've run into a very interesting phenomenon. After a period of very low interest rates over the past couple of years prior to the COVID crisis, many people bought homes with very low mortgages. Well, then, as a result of the COVID crisis, the spending, and then the very high interest rates, we saw a huge ramp up in mortgage rates. Now, those potential sellers don't want to sell because whatever house we sell today, we're going to buy another house, and all of a sudden, we're going to find ourselves in a very high mortgage. Well, we take a very close look at this economic phenomenon. We look back in time to the 1990s and also in the early 2000s when we had a similar situation. Very high interest rates followed by a period of low interest rates where the lock-in effect existed and then dissipated. And we look at some numbers like the unemployment rate and the CPI in order to measure exactly when the lock-in effect ends, because that's really what we want to know now. There's a lot of people out there that may want to choose to sell a house or to buy a house, and this lock-in effect is a very significant story within the housing market. We analyze exactly what it is that ends this lock-in effect and how we can judge the housing market for our own benefits. Now, to read this article and many others, please visit our Substack newsletter, substack.com. Very simply enter in just the data, and you will see the lock-in effect as well as all of our other publications absolutely free to read, no registration required, and you can visit that again at substack.com. We hope this has been helpful. We look forward to seeing you back soon.